Hello and welcome to the Chamber Music Mindset. I am your host, Anna Rathbun. Today we have a lot to discuss. We're going to give a market update. It was a negative week last week, and I'll talk about what was driving some of that performance. And then we have three topics. One is I think AI has sort of entered a new phase as far as investing is concerned in the public markets. We'll cover that. And then secondly, retail earnings. Last week was a big week for retailers like Walmart and Target. We'll talk about some of those earnings and what they have been saying about us. And then finally, we'll talk about what will the Fed do? Because the Fed drives market performance to the degree that I wish it didn't, but that's just the fact of life. So we'll talk about those topics. Before we begin, I have to remind you that nothing you hear in this video is investment advice. Everything is for information purposes only, education purposes only, and frankly, it's pretty much all my opinion. Okay, market update. Let me give you some numbers. It was red across the board. So for the week, the S&P 500 index returned negative 1.9%. Russell 2000, which is the small companies, small caps, returned negative 0.75%. So almost negative 1%, not quite. International markets didn't do well either. So in US dollar terms, MSCI EFA, which is basically developed countries outside of the United States, returned negative 3.4%. Emerging markets returned negative 3.7% on US dollar terms. So everything was a loss across the board. And there was one name to blame, and that name is Nvidia. There was so much riding on this stock, this name. And going into the earnings, which was on Wednesday afternoon after close of market, we were all thinking, we meaning the markets were thinking, if Nvidia tells us that the market, the AI market is robust, then it felt like everything was going to be all right, right? So all of these billions of dollars that are going into AI development, AI infrastructure, data centers, all of these things, the fear is that we're just pouring money into this. These companies are pouring money into these projects. Maybe nobody will use it, right? That's the fear. Or not enough people will use it. There will be overcapacity. Well, so what Nvidia was going to tell us was going to be huge, right? So, up and down, up and down. Nvidia earnings came out. They knocked it out of the park. Jensen Huang, the CEO, even used the term sold out about his sophisticated Blackwell chips. The demand for AI chips is absolutely robust. This was great news, and they beat on earnings, beat on sales, everything. Any company would give a lot for a performance like that. And frankly, the next day, because the report was after market close on Wednesday, on Thursday morning, markets went up, very, very excited. And then it went straight down, all the way down to into the red. So what is going on here? Well, first of all, I've said this multiple times, high valuations will just it will just make the markets jittery, right? So the question it wasn't even about, well, I mean, Nvidia really beat. And okay, AI demand is robust, but is the high price of Nvidia stock really justify all of this? So let's sell, right? And the other thing is there were some notable names that actually sold Nvidia stock. Michael Burry actually ended up closing his hedge fund, basically selling everything, including Nvidia stocks. It came out that SoftBank also sold all of its Nvidia positions. It made it very clear that it's not because they hated the stock. They just needed to free up some cash to invest in other things, or at least that's what they said. Peter Thiel also sold all of the Nvidia holdings in his hedge fund. And I think there was someone else. Warren Buffett sold all of the Nvidia positions. So these things, when prominent names sell the positions, it makes the markets jittery. What do they know? What are they thinking that we haven't thought about? So it was already going into the week on a weak footing. And no matter what Nvidia did, it was going to sell off. I mean, hindsight is 2020. Of course, nobody really knew. I remember sitting at the edge of my seat, just listening to the earnings. You don't really know how the markets will move, but in hindsight, when big names like that move decisively, the markets start wondering and having question mark about why, right? So that was a huge driver of market performance last week. But just because Nvidia sold, just because Nvidia is expensive, um, doesn't mean that non-AI related stocks should sell, right? So what about like Gap? Or I don't know, I'm going to name some retailers because that's on my mind, Walmart or Target, etc. They're going to sell based on their own fundamentals and their own performance, not necessarily because Nvidia is selling. Sometimes the markets have this herd mentality, right? And sometimes it doesn't. And on Friday, that's what it showed. AI related stocks continued to go down, but other stocks went up because the markets felt like they were oversold. So, and the other factor is we started to get some government data. Remember when the government was shut down, we didn't get any data about the economy, and now it's starting to trickle in. And so the markets were busy trying to digest what it means. So some of the movements last week had to do with the markets guessing about what the Fed might do in December and beyond. That is one of the topics we're going to talk about later. Okay, so let's go over some of the data that came in. We got some labor market data for September. Mind you, this is second half of November, so we're talking about very, very delayed data. It's better late than never, but it's kind of irrelevant at this point, right? Because we already had a Fed meeting in October when they cut. So take it with a grain of salt. We apparently gained 119,000 jobs in September. And then the September unemployment rate was 4.4%. Now I'm going to go one more decimal, 4.44. Had it been 4.45, we might end up with 4.5. So this is actually really important because 4.5 is the level at which the Fed is going to start to wonder, okay, are we really heading into toward 5, right? So nevertheless, it is still, relatively historically on the low side, but we're not trending in the right direction. The trend is going up, unemployment rate. The other number that came up with wage growth. Now, we're going to talk about later why this number is important, but it came in at 3.8%, above the prevailing inflation rate. Okay, so in summary, the markets were negative. It wasn't like it went straight down. It was very, very volatile. We're at a point where the markets can't make up its mind. And this is good. Some volatility is okay in the markets. It gives opportunity for active managers to trade and maybe add a little more volume. Volatility allows them to do the thing they were hired to do, right? But it was definitely volatile. I think it's because some of the data is confusing. The AI valuations, the direction of AI, after billions of dollars have gone into investment, the return on it is also a big question mark. There's a lot of uncertainty out there, and the markets are going up and down trying to figure out how to place the bet. So that was the markets. In the next segment, I'll talk about AI, retail earnings, and what the Fed might do. It seems that the AI progression has sort of entered a new phase. I've been thinking about this for a little while, maybe since the earlier on this year, because what happened in the past 2 years is that Mag 7 names, any company, large company that uttered the word AI would observe price appreciation in their stock. Their stock would go up. And this was the excitement, right? The investors didn't know exactly what it meant when they said, we're investing in AI, but it must be something good, especially when tech companies did it, because tech companies, they have the professionals, they have the brains on their staff to be developing these things, right? And then what happened this year, in the beginning of the year or earlier in the year, is that there was a bifurcation. Some names were winning, some names were lagging behind. I'm going to pick on two. One name was Microsoft. Microsoft was just taking off, and it was just pouring in so much money into AI data center projects, and then started to form these partnerships. The investors really saw that as the company to watch in AI development, while Google, or Alphabet, parent company of Google, was lagging behind. What are you doing? How is your, Gemini sucks. Like it's not as good as ChatGPT, et cetera, et cetera. So there was definitely a bifurcation. Investors started to be a little more picky about where to place their capital, right? Whom to bet on. Fast forward to the fall of 2025, suddenly Google has caught up. So Google, or Alphabet, I should call it Alphabet. Alphabet came out with Gemini 3, which is actually really great. It is very, very smart. It has less hallucinations for anybody who uses ChatGPT, or for anything, or any kind of AI, large language model, and any kind of AI software. That it hallucinates, right? But Gemini 3 hallucinates less. And the biggest news really was not only the success of Gemini 3, but also the vertical integration of the fact that Google did not use Nvidia chips. Google used their own chips. I'll spare you the details of all of this, but Google used its own chips. This is the beginning of vertical integration in AI. And this was very exciting news for investors, because this means that there's efficiency, right, in producing AI, something that is usable. And also, it's great news for Alphabet as a stock for investors, because this means that they don't have to go out and buy something that's overpriced, right? So this is a really great news for Google. So while Nvidia fell, Alphabet went up. In fact, it's still up today. It's been like in an upward trend. Everyone is very, very excited. In fact, I heard that, other AI players in the industry are like calling Alphabet and congratulating them, because it has been a success. And so this also begs the question of Nvidia, which has dominated the AI market in terms of chips. Going forward, it's going to have some competition, right? It's going to have some competition because Google is using its own chips. So that's another reason why Nvidia stock is going down. It's not just about the valuation, but this is sort of how the market works, is when you let companies compete, they compete. And so you don't want any one company to have monopoly, right? And sometimes there's a natural monopoly, like Nvidia. I mean, they had the technology, they continue to innovate, good for them. But sooner or later, when you allow competition to happen, other companies catch up. Okay, so this is going to be very exciting to see. I do think that this is another phase of the AI race, because it's a big deal to be able to use your own chips and to be vertically integrated. I think it's a big deal. So I think going forward into 2026, as things continue to develop, we're going to see more bifurcations. We're going to see more discerning investors, especially when it comes to return on those investments. Okay, let's go to retail earnings. So last week I talked about Home Depot. Home Depot was hit from both sides, meaning the housing, I won't call it downturn, but like the housing doldrums, housing weakness. And the other side of it is consumer weakness, okay? So after I made the video, we also had earnings from Target, TJ Maxx, Walmart, Gap, and Ross, among others. So I'm going to pick on I'm not going to pick on Target because Target has its own issues. So no matter what they say about the consumers, the stock price doesn't really reflect us. The stock price really reflects Target's management changes, et cetera. So I'm going to leave that out. And let me talk about first Ross and TJ Maxx. Ross is a discount store. And so they just knocked it out of the park. They did so well. And when discount stores do well, there is this implication that people are looking for value. Now, this isn't anything new. I've been saying this over and over again as long as this video series has existed. And frankly, before I started my company, Granadilla, I've been saying this for like the last 3 years, and at other places, in speaking events. So value, 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 but it's now getting more and more concentrated, right? Because even if you're a high earner in America right now, you're still looking for ways to make your dollar stretch further. So imagine how the low income earners are feeling, right? So Ross stores did really, really well. Gap also did well on the back of Old Navy, which is sort of its discount version among its collection of stores. Walmart, very interesting. So Walmart, over the last few years, Walmart has been catering to higher earners because for a long, long time, Walmart was sort of canary in the coal mine or bellwether for the American mass, right? Everybody. And if Walmart did poorly, it was because people who, would normally traditionally shop there for discounts were not spending money, right? But they realized that higher earners were coming to spend at Walmart. The foot traffic changed. So they started to cater to higher earners. So now they were offering gourmet items in their grocery stores. And they even came up with their own, gourmet brand, a Walmart brand. And now this is like, I did not expect this. Apparently, they're selling secondhand Chanel bags through their e-commerce pipeline. Who knew, right? So again, what they're asking themselves, and they're very smart to do this. Okay, now the foot traffic has changed, the traffic in e-commerce traffic has changed on our website. What are they looking for? What could they potentially buy? What could they potentially be attracted to? So this is an example of a company that in the midst of a headwind in the consumer arena, and it is a headwind, high prices, they're getting creative and looking for ways to gain market share. So Walmart is doing a very good job, and they also outperformed Wall Street expectations. So what does this tell us? It's the same thing except getting worse and worse, which is that we want to retain our purchasing power. We're trying to shop at places where we can pay less than where we used to shop, perhaps, and we're worried about high prices. I mean, that's what this means. And the final version of the University of Michigan Consumer Sentiment Index came out on Friday, and it remained at record lows. I talked about the preliminary number about 2 weeks ago. It was finalized. It remained around the record lows, and the theme is the same. So even the surveys are saying the same thing that these corporations are saying, which is that Americans are really worried about high prices. Now, not everything is, getting expensive as things were getting back when inflation was 9%. No, inflation's around a little less than 3%, right? So it's not increasing as fast, but frankly, it's also not decreasing either. And it increased so quickly that our memory is from like 2 or 3 years ago. I remember what beef used to cost. I remember what chicken used to cost. I remember what cough syrup used to cost, etc. So that meant we have our own personal benchmark in our memory. So everything feels more expensive to us. And if your income didn't keep up with inflation, then you have lost purchasing power actually. So this is on our minds. This is very important to us. And if this continues, and this, we should all care about this. If this continues and it actually ends up changing our behavior or not buying, or what Home Depot said, a deferral mindset on American consumers, and we say, okay, I can go without this, I can go without that, then consumption shrinks. And that's when that can actually have a ripple effect into corporations, corporate earnings, and that could end up being recessionary. I'm not saying that there's going to be a recession. Nobody really knows. But these are the types of trends that we don't want to see. We're not seeing it at the moment, but we don't want to see it going into 2026. Lastly, what will the Fed do? So earlier I talked about government data trickling in, and that really had to do with labor market data mostly. Some people, when we started receiving it, the people who are thinking that the Fed is going to cut or should cut, we're going to call them doves. That's the market term for it. They found what they were looking for, right? 4.44% unemployment rate. It's heading upwards. We're not moving in the right direction. The Fed should cut. The Fed's going to cut. That's a terrible number, right? Actually, also, initial claims and continuing claims numbers came out. And those are the weekly numbers that come out. It actually counts the number of unemployment insurance claims that get filed. And those numbers were also starting to trend up. So, doves had what they were looking for. But hawks did the same. These are the people who think the Fed isn't going to cut, or so it's going to stay put, or they think that the Fed shouldn't cut, right? So these are the hawks. The hawks also had something that they were looking for, which is the fact that, okay, 119,000 jobs gained, that's pretty good. The labor market is just kind of at a standstill because of these extraordinary conditions called sudden tariffs. And also wage growth was too high at 3.8%. You know what that means? If inflation is high and wage growth is high, it kind of starts to feed on itself. And that's when inflation can continue to spiral into higher numbers that are far away from the Fed's target of 2%. Okay, so hawks also had what they were looking for. So it was actually very much a toss-up. Okay, and so that's another reason why the markets had a hard time last week and was very, very volatile in the middle of the day, is because, what does this mean? Can we actually have any direction on what the Fed might do? Now, outside of the government data, we also received a release of the Federal Reserve meeting minutes from October. And suffice to say, if I were to sum it up, it leaned in the hawkish direction. The Fed was very, very split. I mean, it was, and they let us know, I think several videos ago, I mentioned that this is very unconventional for the Fed to show their dissent. And it looks like the December rate cut is not a guaranteed thing, just like Chairman Powell said at the press conference after the Fed rate decision in October. So they're leaning hawkish. We'll see how the data comes out. I mean, we'll see. I don't know. They're not going to get an October inflation data. That's what the government told us. We're also probably not going to get a complete set of October labor market data either. So the Fed is going to be running blind for the December meeting. And this is one of the reasons why a lot of people think the Fed is just going to err on the side of not doing anything because they don't have enough information. That is what a lot of people are saying, and that might be true. Now, even if the Fed doesn't do anything in December of this year, going into 2026, they'll probably cut. Okay, they'll probably cut because if the economy continues to go the way it is, which is sort of like at a standstill, it starts to lose the growth momentum, right? And that'll translate into the labor market data, unfortunately. And when people have a deferral mindset and not buy today and wait until tomorrow or next year or the year after, that is a very deflationary behavior. So they may see inflation starting to come down, maybe not all the way to their target, but certainly trending in that direction. If that happens, we're going to get cuts. So I wouldn't fret too much about December. I wish I could tell all market participants don't fret about December, but that's not how it works. But even if we get a pause in December, 2026 will probably end up being dovish. So those are all my opinions, and that is all I have prepared for today. I hope you have a wonderful week and happy Thanksgiving to every single one of you. I hope you have a wonderful holiday weekend, and I will see you next week.